Welcome to the Beginner's Guide to Brokerage Accounts. Today we'll clarify a critical misconception. Opening and funding a brokerage account is not the same as investing. Cash sitting in your account does not participate in market growth unless you place buy orders for assets like ETFs, stocks, or bonds. We'll also discuss which account type to prioritize, the key prerequisites before you invest, and a simple, long-term strategy you can apply with confidence. If your money is sitting as cash, you face opportunity cost. Inflation erodes purchasing power, and you miss out on compounding. By the end of this video, you'll know how to activate your account properly and avoid common mistakes that slow wealth building. Here is the roadmap for today. First, we'll distinguish between funding a brokerage and actually investing. Next, we'll choose the right account type for your goal, especially retirement. Then we'll confirm you have the right prerequisites in place. Afterwards, we'll outline a simple ETF-based strategy, walk through a decision flow in your first trade, and finally test your knowledge and summarize key points. Before we go further, please note this is educational content, not financial, tax, or legal advice. Your situation is unique, so do your own research, verify current regulations and contribution limits, and consider consulting a qualified professional. Funding a brokerage account is only the first step. If you stop there, your cash earns little and does not capture market returns. To grow your wealth, you must place buy orders for assets such as stocks, bonds, or broadly diversified funds. A practical way to ensure consistent investing is to automate contributions and purchases, which reduces the risk of forgetting or trying to time the market. Before buying anything, identify the goal for these dollars. If this is retirement money, prioritize tax-advantaged accounts like an employer plan or an IRA. These accounts can allow tax-free or tax-deferred growth, which compounds faster than a taxable account where you may owe capital gains taxes. Typically, you would use a taxable brokerage after you have maximized contributions to tax-advantaged options available to you. Tax-advantaged accounts can accelerate compounding through tax-free or tax-deferred growth, but may restrict access until retirement age and have annual contribution limits. In contrast, taxable brokerage accounts offer flexibility and no contribution caps, but gains may be taxed annually. A common approach is to prioritize tax-advantaged accounts for retirement goals and use a taxable brokerage for additional investing once those are maximized, or for goals that require flexibility. Before investing, confirm your foundation is secure. Build an emergency fund covering 3 to 6 months of necessary expenses. Pay off high-interest debt, such as credit cards, to avoid compounding against you. Any money you need within the next 5 years should typically not be invested in volatile assets. Finally, write down your goal, expected timeline, and a realistic monthly contribution to maintain discipline. A straightforward strategy is to use broad, low-cost index funds, or ETFs, that track large segments of the market, like total market or global stock funds, paired with a bond fund for stability. This approach provides diversification and keeps fees low. As a beginner, avoid picking individual stocks or trying to time the market. These behaviors often reduce returns. Fractional shares make investing small amounts feasible. Automate contributions and rebalance periodically to maintain your target allocation. This flowchart guides you step by step. First, decide whether the goal is retirement. If yes and you have an employer plan with a match, prioritize that to capture the match. Next, consider contributing to an IRA. After maximizing tax-advantaged options, additional investments can go into a taxable brokerage. If the goal is not retirement and the time horizon is under 5 years, keep the funds in cash or short-term, low-volatility vehicles. Ensure a 3 to 6 month emergency fund before investing, and always note that tax-advantaged accounts may have access restrictions before retirement. Here is a simple Markdown template you can adapt. For a long-term allocation, a common example is 80% in a global or total market equity ETF and 20% in a high-quality bond ETF. Keep costs low and the structure simple, then rebalance once or twice per year. Use fractional shares to deploy exact dollar amounts. Favor broad, total market funds rather than narrow themes. Finally, write an investment policy statement to formalize your rules and reduce emotional decisions. This table summarizes 3 common account types at a high level. Employer plans are primarily for retirement, with tax-deferred or Roth options and annual limits. IRAs also serve retirement goals with tax-deferred or tax-free growth and annual limits subject to eligibility. Taxable brokerage accounts are flexible with no contribution limits, but gains and dividends may be taxed yearly. Always verify current rules because limits and eligibility can change. Quiz time. The question is, true or false? Once you deposit cash into your brokerage account, you're invested in the market. Option A, true. Option B, false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is false. Depositing cash into your brokerage account does not make you invested. You must place orders to purchase assets for your money to participate in market movements. Here is the second question. If your goal is retirement and you are eligible, which should you generally prioritize first? Option A, taxable brokerage. Option B, Roth IRA or employer plan. Option C, meme stocks. Option D, regular savings account only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. For retirement goals, prioritizing tax-advantaged accounts such as a Roth IRA or an employer-sponsored plan can significantly improve long-term outcomes due to tax-free or tax-deferred growth. To place your first ETF order, search for the fund by its ticker symbol. Choose an order type. A market order executes at the current price, while a limit order executes at a specified price or better. Enter the number of shares or a dollar amount if fractional shares are supported. Review any fees, confirm your order, and submit. Afterwards, enable automatic contributions and, if available, automatic purchases to keep your plan on track. Remember these core ideas. Cash in your brokerage isn't invested until you buy assets. For retirement money, prioritize tax-advantaged accounts before taxable accounts. Use a simple, diversified, low-cost approach such as broad index funds or ETFs. Finally, automate contributions and rebalance periodically to maintain your target allocation. In summary, ensure your emergency fund and high-interest debt are addressed before investing. If the goal is retirement, start with tax-advantaged accounts. Implement a straightforward ETF-based strategy. Automate your contributions, and refer to the decision flow whenever you allocate new money. This structure helps you avoid common pitfalls and stay consistent for the long term. Thank you for watching. If this video clarified the difference between funding and actually investing, please like the video, share it with someone who needs it, and subscribe for more beginner-friendly finance lessons. In the comments, tell us your next step: opening an account, choosing an ETF, or setting up automation, and what topics you want next.